Thank you, Michael. And I'd like to start by thanking the CFA Society for the opportunity to speak to you all here today. So, a key part of the Monetary Policy Board's deliberations each time they meet is to assess whether or not financial conditions are tight, easy, or neutral in terms of their effect on aggregate demand. It then determines whether those conditions are appropriate to achieve its goals of full employment and low and stable inflation, and it adjusts the cash rate target if needed. Today, I'm going to speak about three key building blocks that we use to assess financial conditions. And while the cash rate target is a good starting point, it's not a reliable guide because it doesn't account for other factors affecting financial conditions, including structural changes in the economy. Hence, it's worthwhile to look at three things. First, compare the cash rate with estimates of the neutral rate. But I would emphasise that those estimates are highly uncertain. Second, consider a broader set of financial indicators which also help to track the transmission of monetary policy through the economy. And third, to examine the RBA's macroeconomic forecasts, which incorporate measures of financial conditions and economic conditions. So these three building blocks point to policy as having been restrictive from around 2023. More recently, though, there are signs that restrictiveness has declined following cuts to the cash rate target and with funding readily available to a wide range of household and business borrowers. So as I suggested, the cash rate target, that's a good starting point for my talk today because it's a key focus for commentators assessing financial conditions, and rightly so. It's got an important bearing on interest rates in the Australian economy, and it's the instrument that the board sets to influence financial conditions. But it's hard to assess financial conditions by looking at the cash rate alone, and that's because its past behaviour is not a reliable basis for comparison. Now, one pretty simple reason for that is how tight or easy a given cash rate is depends on expectations both for inflation, but also expectations for the cash rate itself. So, for example, the benefit of a high interest rate to a saver, that's going to be reduced if inflation erodes what their money could otherwise buy over time. And similarly, the burden of a high interest rate on a loan is eased for a borrower if nominal wages or if profits are rising quickly. So to address that, we can compare the cash rate to estimates of the nominal neutral rate, and that's going to adjust for changes in inflation expectations over time. But the neutral interest rate is more than that. It's also a useful comparator because it accounts for changes in global developments and Australia's economic and financial structures. And those in turn influence how any given level of the cash rate is going to affect aggregate demand. The neutral cash rate is the rate that is neither expansionary nor contractionary over the longer term. In other words, it balances investment and savings at levels that are consistent with full employment and stable inflation once all of the shocks fade, and assuming there are no more shocks. So conceptually at least, comparing the cash rate to the neutral rate helps to gauge the restrictiveness of policy. So the RBA estimates neutral interest rates using several models. I'm going to focus just for a moment though on the average of those models' central estimates. I'll turn in a minute to the important differences between them. But for now, what the average of all of those models suggests is that the neutral cash rate has trended lower over recent decades. And that's a pattern that is very much seen in other economies. Now, this trend is likely to reflect structural shifts, including things such as demographic change and slower productivity growth. And those sorts of shifts can increase savings, can reduce investment, in which case lower interest rates are required, are needed to balance those two. So even though the cash rate's been much lower in recent years than in previous decades, that doesn't imply a one-to-one easing in financial conditions, because the neutral rate has also declined. So indeed, a cash rate of around 4% in recent times, that may have been just as restrictive as 7% was 3 decades ago, if indeed the neutral rate has fallen by around 3 percentage points since then. So in recent years, central estimates of Australia's neutral rate have risen by about 1 percentage point on average. Factors contributing to this include rising global public debt, maybe lower savings by retiring baby boomers, increased public and private investment, including, but not exclusively, in the green energy transition. This rise in the neutral interest rate implies that any given level of the cash rate is now less restrictive than it otherwise would have been. So far I've compared the current cash rate with neutral estimates at a given point in time, but we also need to consider cash rate expectations. And that's because they can influence longer term interest rates, and those in turn affect current savings and investment decisions. So a declining expected path for the cash rate, as is shown here in graph 2 for the dashed line using market expectations. A declining path such as that, for example, implies easier financial conditions right now compared to a flat or a rising one. But there are limitations to using the neutral rate estimates to assess whether financial conditions are tight or easy. And the main limitation is the estimates are imprecise. And this has 2 aspects. If this looks a bit spaghetti-like, that's the point of the graph. The first point is that the first limitation is that estimates are very uncertain. So the span of central estimates, which is shown here by each central estimate is the one grey line, but the span of those central estimates across the models is wide. We don't know which model best measures the neutral rate. And each of these central estimates is itself derived with uncertainty. Even so, assuming that our models cover the set of reasonable descriptions of the neutral rate, we can have some confidence that cash rates well above the range of central estimates would be constraining aggregate demand, and vice versa for rates that are well below that span. But we can be less certain for rates that are closer to or indeed within that range, as is currently the case. So that's one limitation. A second limitation is that the models may not capture all of the key aspects of financial conditions, or at least not do so in a timely manner. Indeed, 4 of our models rely on macro data. So that data is only available with some lag, and it reflects what was happening in the past financial conditions. So that makes them slow to respond to new developments. And those are the 4 models that are currently showing the lower estimates in this chart. The 3 other models are forward-looking. They extract estimates of future short rates from bond yields of various maturities, and so they're potentially quite responsive to changes affecting the neutral rate. But again, they too are estimated with considerable uncertainty. So given these limitations, neutral estimates form only part of our assessment of financial conditions. We also consider a broader set of indicators of financial conditions, which I'm going to turn to now. So one benefit of looking at these various financial indicators is that they can help us track the transmission of monetary policy through to the economy. And they can also suggest whether financial conditions align with movements in the cash rate or perhaps are behaving in ways that are amplifying or dampening its usual effects. I'm going to just focus on a few, but of course we refer to a much broader set, and we publish those regularly in our statements on monetary policy. So changes in the overnight cash rate influence other interest rates, including those affecting banks' funding costs and lending rates for households and businesses. So this graph shows the differences between funding costs and the cash rate in the top panel, and the differences between loan interest rates and the cash rate in the middle panel. These spreads reflect factors that are influencing both sort of supply and demand conditions in those markets. So as I said, the top panel shows the spread between estimates of the major banks' funding costs and the cash rate, and those were very low before the global financial crisis. So depositors at that time were receiving low returns relative to the cash rate, and the bondholders were requiring little compensation for any given level of risk. But then that spread rose very sharply during the crisis as credit risk concerns grew and banks shifted from short-term wholesale debt and securitisation to more stable funding sources. Now skip ahead a few years. During the pandemic, the funding cost spread fell, and part of that was in response to the RBA's unconventional policies. But it's stayed low since then, and that reflects, amongst other things, a higher share of at-call deposits and more recently, low wholesale debt spreads. Variations in banks' funding costs and banks' willingness to take on credit risk and compete for borrowers, those things have underpinned movements in key lending rates to household and businesses, and these are shown as spreads to the cash rate in the middle panel of this chart. So these spreads have narrowed in recent years, and the bottom panel, the last one, shows the cost for larger businesses when they go out and raise funds by issuing their own bonds. And they're shown as a spread to Australian government security yields, and they're currently also at very low levels. So if we go back, the sharp rise in banks' funding costs and then those pushed through to lending rates, lending spreads during the global financial crisis, those tightened financial conditions very sharply, and that's one reason why the RBA cut the cash rate sharply at that time. However, current loan spreads suggest financial conditions are now less tight, at least than they were a few years ago, for any given level of the cash rate. And that's consistent with the rise in neutral estimates that I just mentioned. So let me turn to household financial conditions, or at least some measures of those. The cash flow and intertemporal channels influence household savings, consumption, and housing investment. And these are key channels for monetary policy transmission, and the associated indicators are pretty useful, therefore, for assessing financial conditions. What I've shown here is some data on mortgage payments. The mortgage payment data offer some insights into how these channels operate. And while required payments have declined this year, as you can see, small declines in those in the top panel, as the cash rate has passed through to banks' lending rates, they do remain elevated due to interest rates being above pre-pandemic averages. And then the bottom panel of this graph shows that mortgagees, they typically pay more than the minimum required in Australia on their housing loans. And in response to high mortgage rates, extra payments rose above the pre-pandemic average by the end of 2024, at least as a share of disposable income. And I think that was consistent, at least, with the incentive to save more when interest rates are high. But extra mortgage payments have declined more recently. That's possibly an early response to the easing in interest rates we've seen this year. Now, lending rates can affect household credit by influencing housing prices, borrowers' ability and willingness to take on new debt, and the incentive to repay existing debt. And this was evident as interest rates rose from 2022, with the subsequent decline in the ratio of household credit to household disposable incomes consistent with tight monetary policy. Now, housing credit growth has picked up as interest rates have declined this year, and housing market conditions have certainly strengthened, so that's consistent with an easing in financial conditions. But I would note, however, that the stock of household credit, excluding offset balances, that's the dashed line in this graph, that's still falling relative to incomes. And by itself, that doesn't suggest that financial conditions are easy. What about business debt? Well, the ready availability of funding at favourable spreads has supported the rise in business debt in recent years, shown here as a share of GDP. Strong competition amongst the banks, amongst the non-banks as well, healthy loan books and improved economic outlook of late have underpinned the supply of credit to businesses. And large businesses have also benefited from those low corporate bond spreads I just showed you. So non-financial Australian corporations, they're issuing bonds at record levels this year. The thing is, business investment has historically had a pretty weak direct relationship with aggregate business debt, as that sort of investment is mainly internally funded and influenced by factors like profitability and economic conditions. Even so, strong business debt is consistent with a positive outlook by businesses and lenders, and credit growth also contributes to the money supply, which can offer a timely, although a quite imprecise, signal of trends in aggregate demand and inflation. So these indicators that I've discussed add some context, and taken together with the neutral rate estimates I've also shown you, they help to assess how tight or easy financial conditions are. However, those two building blocks cannot determine if policy stance is appropriate for achieving the board's goals. That's because they do not account for all the factors that shape the economic outlook, including recent shocks and other cyclical influences. And so for that, we rely on the RBA's economic forecasts. Now, when we're forecasting, we look at the current state of financial conditions, and as a technical assumption, we assume that the cash rate follows the path implied by market pricing. But our forecasts also incorporate a wide range of macro factors shaping the domestic outlook, such as conditions in major trading partners and Australian government fiscal policies. So this approach helps us to assess whether financial conditions are such that the board's inflation and employment objectives are likely to be met. And if not, then it implies the board might need to consider a different path for the cash rate than that which is implied by market pricing. So in addition to the market path for the cash rate, our forecasts assume the Aussie dollar, at least in trade-weighted terms, remains at its current level. We have several other variables, financial variables that feed into the forecasts. So just by way of example, household consumption, that's influenced by housing lending rates, by credit growth, and equity and housing prices. And the cost of capital, which incorporates business lending rates, that feeds into models of non-mining business investment. Despite the inclusion of these measures, the models that form the starting point for our forecasts may not properly capture financial conditions, so a judgment about this dimension is required, alongside judgment about other macroeconomic factors. For over a year, forecasts in the Statement on Monetary Policy have assumed that the cash rate would gradually decline through 2025 and early 2026 before stabilising. The forecasts have implicitly reflected an assessment financial conditions were restrictive and were restraining demand, and that was helping to bring demand and potential supply into better balance and easing labour market tightness. And as a result, underlying inflation was expected to gradually return towards the midpoint of the 2 to 3% target range. But with the economy approaching balance, policy was expected to move towards a more neutral stance. Now, we can use model estimates to at least get a glimpse of how the outlook might have been different if the cash rate path were to deviate from the baseline that we'd used, and that's what this chart aims to do. The red shaded area in this chart shows projections for inflation and unemployment if the cash rate was 50 basis points higher at one extreme or lower than the August S&P baseline. So just for example, if the cash rate was 50 basis points higher, all else equal, inflation would be expected to fall below 2.5% and would have been expected to be declining by late 2025, while unemployment rate would have been expected to be around 4.5% and rising. In summary, based on what we knew at the time, the cash rate paths that deviated too far from the August S&P baseline would have been less likely to meet the board's goals for inflation and full employment. However, it's worth stressing our macroeconomic forecasts carry significant uncertainty. So this includes uncertainty about that assessment I was talking about of how tight or easy overall financial conditions are, and that has been and will continue to be closely scrutinised. Historical forecast errors, illustrated by the fan charts shown here, they show that the range of potential outcomes for underlying inflation and unemployment is very wide out beyond the near term. So in conclusion, I think it makes sense to use a number of different methods to assess financial conditions given the considerable uncertainty involved with each of them. That first building block, I think the conceptual cornerstone, if you like, that's to compare the cash rate with estimates of the neutral rate, the nominal neutral rate. Now, model-based estimates of the neutral rate suggest financial conditions have been tight, thereby working to restrain aggregate demand. Based on the market path, the cash rate is expected to sit, though, within the wide range of central estimates of neutral over the coming period. However, even that range understates the degree of uncertainty, and while neutral rate estimates are a useful cross-check, they're certainly not a suitable guide to the near-term path of monetary policy. Nevertheless, what neutral estimates suggest, or have been suggesting, accords with a range of other financial indicators of, a range of other indicators of financial conditions. So these indicators offer more timely evidence of monetary policy effects than measures like economic activity and inflation. And indeed, several indicators of financial conditions, including mortgage payments and housing credit growth, they show early signs of responding to the easing in financial conditions this year. And then finally, the RBA's macroeconomic forecasts are based on a range of financial indicators, including the expected path of the cash rate implied by market pricing. Our forecasts, looking back at them, have implied that the tightness in financial conditions has eased, which will help keep the economy in balance in the period ahead, with full employment and inflation expected to move towards the centre of the target range. However, this outlook is subject to considerable uncertainty, and as always, we're going to continue to reassess it in light of what the incoming data mean, but what they mean for the economic outlook and the evolving risks. So thank you all very much for your attention, and I think I'm in Michael's hands now. We'll take a few questions. Thank you.
Chris, can I maybe take you back to, in my introduction, I noted that your role at the RBA. So what does, for ordinary citizens like we are, what does the Financial Management Group actually do, Markets Group, sorry, do day to day?
Well, a lot of what we do day to day is actually what I talked about in my speech. We do research and analysis on financial conditions, leading ultimately to sort of asking that question, are they tight, easy, neutral? A lot of my talk, though, was quite focused. I gave mention about global developments, but a lot of it was focused on the domestic sort of financial indicators. But of course, we look very much offshore to offshore financial market developments, and especially what other central banks are doing, because those have important implications for financial conditions here. So we do that. A lot of that work finds its way into the Statement of Monetary Policy, into board papers, speeches, and the like. But the other side of what we do is operational. So we're responsible, if you like, when the board pulls that cash rate target lever, that tells us we need to act. So we implement monetary policy. So that some of that's through domestic operations in markets, in money markets, working to implement that, generate the outcomes the board's asked. And we also provide along the way liquidity to the banking system. We manage the FX reserves, you mentioned that, including through our offshore offices in London and New York, so we can trade while markets are open 24 hours. We also are the banker for the government, and so that means in my area we purchase foreign exchange to meet the government's needs. And then maybe perhaps less understood, but we interact quite a lot with the IMF, with the BIS committees, and we work closely with central banks in our region. So those are sort of the sort of things that keep us busy.
Wide range.
Yeah.
So just give us some context, how large is your team?
A bit over 150.
Right, and so you've been there, as I said earlier, nearly a decade now. What does leadership look like of 150 people within the RBA? I'm guessing quite technical people in many regards. So what does leadership mean for you in that kind of role?
At least for me coming in, the thing is I had spent the better part of my earlier career with a macro focus. I'd been the bank's chief economist.
Yep.
I'd spent time in payments and financial stability. I'd been at the IMF. So I had a very macro focused background and not much in financial markets. So I think the value I add in coming in is saying to everybody, it's okay to ask lots of questions. Sometimes those can be quite stupid questions, but sometimes stupid questions actually have a nub of something really important in them. And consistently be open to the fact that I'm probably wrong on things. And I think I'm very happy to be told how wrong I am, because that means I've really learned something in my day. So I think if you can illustrate that that's an okay way of being, that's a good way of leading a group like that, because it makes them inquisitive and open to discussion.
I was about to say exactly that, curiosity and working out why somebody's got a different view than your own is such a valuable thing to do. Okay. Now suddenly, all of my questions have disappeared. Jackie, I don't know. There we are. Excellent. So now we've got quite a few more questions, and you've all been very busy at voting them up. So thanks for that. That's great. So let's tackle a few of them. The most popular question is, what does the RBA think about the growth of private credit markets in Australia and indeed globally?
So it's something we've been looking at. I think in Australia there has been quite a bit of growth, but in the scheme of things it's still pretty small share of total funding.
Right.
So the sort of concerns you might pick up if you're reading the FT or publications offshore, or looking at BIS or IMF publications, for example.
Or reading ASIC notices.
Indeed. Those sort of concerns in terms of financial stability, in terms of financial conditions, I think are much less relevant here.
Right.
It doesn't mean they couldn't become relevant. I think on the ASIC point, that's a good point. That was very much about, in a space which is quite unregulated, it's very important to have full disclosures. Yeah. So investors coming in can come in with their eyes open to the risks that are being taken. Okay,
very good, thank you. And the next question, interesting question given recent news articles about long queues in Martin Place. But is the RBA considering increasing the share of gold in its FX reserves?
I think the honest answer is no. It's not something on my mind. I mean, we do hold stocks. They've been held very steadily since the late 1990s, when we sold down some of those reserves. But there's no imminent plans. Yeah, okay, good. Thank you. Next question. Amid US and China tensions and shifting supply chains, how does the RBA view the impact on Australia's trade and capital flows? I think the direct impact for us has been so far, as best we can tell, pretty modest. I think the initial concern was just the effect of uncertainty this was creating and the adverse impact that might have on investment. I don't think that's been a significant factor here. I think the bigger concern is what it might mean for the health of our key trading partners, particularly China. China so far has certainly, their exports to the US have fallen significantly, but a lot of that seems to have been diverted elsewhere. Yeah, right. And it doesn't seem to have had a very significant overall effect in terms of their, say, demand for our commodities, which is key. And if we look at those commodity prices, some of those key ones haven't changed that much over the course of this year. Not to say that,
Yeah.
the aforementioned gold, of course, is an important commodity for us, but that's unrelated, I think, to these
Sure.
trade uncertainties.
So you'd focus more on the impact on trading partners, especially China, rather than the Australian economy directly?
Well, there's not much evidence that
Yeah.
it's having a very direct effect on us. Not that it's not having any, but just not a significant one.
Okay, thank you. We can't have a conference these days without talking about AI. So how are you incorporating AI into your modelling? Or, or anything else?
Well, I think you're seeing it having a pretty significant effect on the value of assets and therefore wealth. So you might be looking for it to have effects there. It's a contributor to easy financial conditions globally through higher equity prices. It's contributing to significant investments, particularly in the US, but not solely in the US.
Yeah.
I think the big unknown is what does it mean for longer term productivity, set against the backdrop of a trend decline in productivity over quite a few decades. Is this something that's going to turn that around? And we just don't know yet.
Yeah.
So it's something we'll watch. Of course, financial markets are digesting all of that all the time, and at least in theory, that should be captured by some of those neutral rate estimate models.
Yeah. Okay, great. Thank you. Based on one of your first, or your early charts in your presentation that looked at interest rates over the last couple of decades, official rates recently kind of peaked at 4 or 5% in that range. So on the 20-year chart, don't look that historically high. And yet when we lived through that, especially for people a little bit younger than I am certainly, who had never seen rates at 4 or 5%, it seemed like the sky was falling in. So how does the RBA think about those recent rates in a historical context?
I think that was the point of that early discussion about the trend decline in the neutral rate estimates. Because these are global forces, demographic change, the decline in productivity, that mean any given interest rate, cash rate, let's say, is going to have more of a tightening effect on the economy than in the past. So we didn't need to raise rates as far as 7% to have the same effect as we might have done a few decades ago. A large part of that is that decline in sort of neutral rate driven by those structural forces. A little bit maybe on inflation, but remember inflation of late was fairly high, but inflation expectations didn't go up too much. So, but the board was quite conscious of that, we were quite conscious of that, and therefore cautious and careful. Even though rates were raised quite quickly, we didn't raise them quite as far as others, and they did seem to have the desired effect with everything else that was going on in the economy.
Yeah. You must have to be really conscious of the way in which interest rates are transmitted to normal citizens as well.
Yeah, and look, people do say, oh, but debt is so much higher, so it's going to have a much bigger impact. And that's probably true through the cash flow channel to a degree, but as you could see, as a share of people's income, that household credit hasn't really trended up since sort of the early 2000s.
Right.
And I think people tend to overestimate the cash flow channel as the most important transmission mechanism, because I don't think it is. It's all the other channels that are still quite important. The exchange rate is an important one, but also the intertemporal channel. When interest rates are high, it provides an incentive for people who have borrowed to pay down their debts faster than they otherwise would, and for people who don't have any more debt to save much more than otherwise.
Okay, that's a great perspective. So one question here is, over the last decade, the cash rate has averaged almost 1% less than CPI, and tax rates worse than this. This is negative for productivity and Australia's long-term prosperity. Why does the RBA insist on punishing savers and rewarding borrowers?
Well, I think part of those statistics reflect that period leading up to the pandemic where, as a central bank, we were struggling to get inflation back up to target.
Right.
It was too low.
Yeah.
And in essence, that reflect an excess of savings over investment.
Mm-hmm. Yeah.
Here and probably globally as well. So our objective is in trying to stabilise inflation and bring it back up to target was to stimulate the economy in the way that we can, and that was to keep the cash rate low. But I don't think that lower interest rates or indeed higher interest rates affect productivity in the long run.
Right. Interesting. Okay. All right, last question as we are approaching our time limit. What do you think is one of the biggest misconceptions that people might have about the work of the RBA or the role of the RBA?
Well, there's quite a few.
We haven't mentioned housing
just
somehow
one,
in this conversation.
Yeah. That our policies are driven with an eye to having an effect on housing prices.
Right.
Yeah. Our goals are full employment and low and stable inflation.
Right.
I think what's increasingly recognised to everyone's benefit, but we need to make some inroads here, is that what really matters for housing prices relative to incomes and affordability is supply.
Yeah. Sure.
We have temporary effects on demand,
yeah,
but I don't think we have long-run effects on demand.
Okay. Very good.
Okay.
Well, Chris, thank you so much.
Well, thank you,
can I ask everybody to put their hands together and thank you?
Thank you all. Thanks.
Thank you, Chris.